Hey traders, this is Ron. Happy Thursday morning. Hope you guys are doing absolutely great. As always, everything in this presentation is always for educational purposes only and always in a virtual paper trading account. I wanted to put together a quick video this morning. I'm using Thinkorswim. We're about a half hour before the market opens here in the US, East Coast time, and daily chart of the Qs. The Qs are the ones that are having a bit of a problem here. If I zoom in, you're going to see this was the high before the Corona crash, and then the subsequent rally, which has been utterly amazing. There's two lines on my chart. The red line is the 20-day EMA. That's a 20-day exponential moving average. It's a really good trailing stop, if you will, just to give you more of a momentum moving average. It's a month's worth of trading data because there's 5 days a week times 4 weeks. 5 times 4 is 20, so it's almost a month. And if the stock stays above it, it's pretty strong in trend. When it gets below it, it shows you that the shorter term trend might be changing. And once we got back above it, in April a year ago, we pretty much stayed above it almost the whole time. And when it gets below it, you want to go to the orange line, and that is the 50-day SMA, simple moving average. This is the institutional moving average. I don't give it that name. The investment community gives it that name. Stocks that are above it are viewed as institutionally bullish. Stocks that are below it are viewed as institutionally bearish. Doesn't mean the stock's going to go to the moon or crash. It just shows you the sentiment, quote, of the big money. Now, it doesn't always work. Nothing always works all the time. We got below it in September this past year, got back above it, got below it in November, got back above it. We've been above the orange for now quite a while. If I zoom in, we're now starting to stay below it. And I did a video for you guys last week. And on the 23rd of February, so 1, 2, 3, 6, 7 trading days ago, we opened below it, traded all the way down here, and then closed back above it. That was the probe, and it occurred on big volume. Now, even though the bar is very tall and it is red, meaning it still was a down close on the day, it shows you there was definitely some buying coming in. This was sort of putting your foot in the water to see what happens. The next day, we also gapped down, but then we close higher. Volume really peels off. And then 5 days ago, we get the breach. And I said to you guys, we really want to watch that low and the intraday low. Well, the next day we put a doji, we barely test it, and we break it. Again, it's sort of just probing, seeing, hey, what are the orders down there? Can we run it? Can we break it? Can we break the bulls back? And you end up with a doji. No big deal. The next day, we come back up. We get above the 50-day. Okay, so 2 days below, we get back above. Can't break the 20-day. What was previously support can become resistance, and that's how technical analysis works. The very next day, which was today's Thursday, that would have been Tuesday, we do gap up a little bit, hit that red line, and then boom, down we go, and we complete bearish engulfing. Volume, it didn't really soar, but it still is above average if you go back over here. It's nothing extraordinary though, but bearish engulfing at a key resistance area, and you go back below the 50-day, if you were to start throwing, bearish engulfing by itself isn't a big deal. Not getting above the red line isn't a big deal. But you say, wait, so you've broken moving averages. You're now trying to get back above so the bulls can regain control. You hit your head right on it. You then go lower, you bearish engulf the previous day, and you break the 50-day. Okay, that's a different story. Those are three things now coming together, confluence. And then what happens yesterday on Wednesday, the 3rd? Gap lower, and then we closed the lows, and volume increased. This is not a good sign for the bulls. We have now broken 3 days of support. Now, I can't tell you why that 310.96, call it 311, was a buy point. That's just the players in the market, the big money, because the big money is what moves markets, said, hey, that's the area we're going to buy. No idea why. They just did, and the proof's in the pudding. You can see it on your screen. The fact that we broke it, all those people that bought and defended that level are now wrong. So when you break it, that adds to the selling pressure, and then we closed the lows. That tells you that they weren't willing to buy dips and go long into the next day. They wanted to not only get out, but get out at the end of the day. So they lost. That battle has now been lost for 3 days. If I zoom out, when it comes to technical analysis, I like to connect as many dots or lines as possible. There are no other major pause points. If I come over, where are we at? 309, I'm just going to round it up. We closed at 308.98, so 309. I mean, there's a little bit of a high here, but that's a buck or two lower. There's no other confluence to the left on this chart going back a few months. Therefore, I zoom out again, and I have to say, well, where is the next major stopping point? And you start coming down to gaps. 280, that's 20, what? Yeah, about $28 lower. Swing low here, swing low here. Doesn't mean we're going to get there. We could use Fibonacci retracements. We could use all these different things. But going where there was last major battles, swing points, you're down here. Now, there is a possibility there was a high here and a high here. We break it, we test it. I could potentially say maybe 298, 299, ballpark rounded off 300, another $9 lower. Maybe that would be support. But I would call that a lower quality support around 298, 300. The big ones now would be the swing lows. So we'd come down here, probably fill the gaps. From a technical standpoint, those are targets. No guarantee, we're actually going to get there, but that's not what we're looking at. So if you're saying, does this look ominous? Absolutely. Breach the 50-day, can't get above the 20-day. Then when you finally do, you quickly bearish engulf it, you break it on high volume, and you close below the other buy points where bulls tried to make a stand. Yeah, this would be a technical, a picture in a technical book. If I was teaching technical analysis, this is not good. Doesn't mean we're going to crash, but if you were bullish on the Qs, and if I had a bullish position on the Qs, you do not like this right now. So what are some things I could consider? Well, if I was trading the Qs, which I'm not, but let's just say I was in a paper trading account, I would now be considering, if I had long Q shares, I would be considering long puts, maybe out 90, 120 days in time, right near the money, right where the stock is trading. I would consider covered calls at the very least now, probably up here at resistance, which is 324. We have 1, 2, 3, 4, 5, almost 6 candles right around 323, 324. I could put short calls in play there. I could convert this to a collar trade for now. For the bulls to take control of the Qs, it needs to get back above not just the 50-day, but the 20-day, because it also acted as resistance. So it can do that, and we've seen it before. If I come back here, hey, we broke both. That didn't look so good, right? And got right back above. So if this were to play out again and we get back above the 50 and the 20, that's bullish. Now my protection would be, I would consider eliminating it, getting rid of the long put, maybe buying back the short call, or leaving the short call in there until it gets near or close to the money. Same thing over here, we get back above. There was a push, back to bears, back to bulls. But this is how it starts. And the difference here versus some of these other patterns, it has more going for it because we're closing at the lows of the day. It's amazing what that one candle now can do in the context of those other days. All right, let's take a look at the spiders now, spending so much time on the Qs, but I think it's a good teaching point. Spiders, they are not below the 50-day yet. And SPY 380, so we're trading down about 60, 80 cents. If they get below the 50-day, I'd want to see them also break below Monday's close, which is 380. Anything below 380 is a breach. We would go to this level, and then there's a little bit of support in the 360s, but you start coming all the way back down here. We are due for a correction. Whether or not it manifests, I don't know. Here are the diamonds, the Dow. It hit the 50-day on Monday and right back up, but no staying power. It's the strongest of the three. If the Qs get below the 50-day, that would be a bad sign. So we only have one index of the major three breaking so far. The Qs are the one I would be more concerned and more cautious with. If you go to Apple, what is Apple then? Remember how I used to say, and I still do, how goes Apple, so goes the market. Well, Apple broke the 50-day back on 217. Let's track that to the Qs. Here was 217. The Qs were still up here. You could say in this case, Apple was a leading indicator. Everybody, the funds, quote, the majority of people are following and trading Apple. Well, let's zoom in. Once we broke the 50-day, we came down, big, long candle here, long tail. We go right into the 20-day in red and immediately shot right back down. This is classic sell-off, oversold bounce, and we're going right back down. Now for Apple, interestingly enough, it's sort of turned around at some of these other lows. I would say a downside technical target for Apple. I want to come over here and look for swing lows. There's a 2-day swing low here around 113-ish. The bigger one is down here at 108 and then down here at 104 if we can get there. There is a head and shoulders in here too, but the trend is just simply down. We take a look at something like Amazon. It's also rolling over. And Amazon is actually seasonally bullish this time of year too. So the fact that it's rolling over is also telling you, you know what? The market just wants to pull back here a little bit. It's below its 50. It's technically bearish. Amazon's going to have to break probably 2,900. And that would be bad news if you're an Amazon bull in the short term. Below 2,900 is right there. You're going to have a low here, a low here. I mean, the next support's in the low 24s. Could be a ways down if that happens. And Microsoft, which has been pretty strong, it lost its 50-day. You see how it took out the lows? Its target's now going to be down here too. If we look at gold is not catching a bid. It's selling off. Silver, it's holding up better than gold. This is interesting. I want to keep an eye on silver, not due to seasonality, but just in general. And bonds, TLT, if we zoom in here, these guys cannot get 2 consecutive days above their orange line, which is their institutional line since what? It really broke it back in August. You had your short-term bounce and it's still rolling over. It too is still bearish. TLT for bonds would have to get back above the 20-day in red, and then your target would be the 50-day at that point. But these guys are bearish too. Okay, a little longer video than I thought. So there's your quick wrap up. If the market starts getting even more squirrely, I'll try to put out some more videos as well. Wish you guys all the best and have a great day.